Financial statement analysis is an essential tool for evaluating an entity's profitability, liquidity, efficiency, solvency, and long-term sustainability. Techniques such as ratio analysis, trend analysis, earnings per share, EPS, analysis, and cash flow interpretation enable investors, lenders, regulators, and management to assess corporate performance and financial position. However, these techniques possess inherent limitations arising from accounting policies, historical cost measurement, management judgment, inflation, and differences between industries and organizational objectives. Furthermore, financial analysis of not-for-profit, NFP, and public sector organizations differs fundamentally from that of commercial enterprises because their primary objective is service delivery rather than profit maximization. Limitations of ratio analysis. Ratio analysis transforms accounting data into meaningful performance indicators, but its effectiveness depends heavily on the quality and comparability of underlying financial information. One major limitation is that ratios are based primarily on historical financial statements, which reflect past transactions rather than future performance. Economic conditions, technological developments, competitive pressures, and regulatory changes may significantly alter future profitability despite favorable historical ratios. Ratio analysis is also affected by inflation, as historical cost accounting may understate asset values acquired many years earlier, artificially improving return on assets and asset turnover ratios. Furthermore, year-end financial statements represent a single reporting date, which may not reflect average trading conditions throughout the accounting period. Seasonal businesses may report unusually high inventories or receivables at year-end, distorting liquidity and efficiency measures. Ratios should therefore be interpreted alongside broader economic, strategic, and operational information rather than in isolation. Effects of different accounting policies. The usefulness of ratio analysis depends upon consistent accounting policies across reporting periods and between comparable entities. Differences in accounting policies may significantly affect reported profits, assets, liabilities, and financial ratios without reflecting genuine economic differences. For example, different depreciation methods alter reported profits and asset carrying amounts. Alternative inventory valuation methods influence gross profit margins and working capital. Cost and revaluation models for property, plant, and equipment produce different return on capital employed calculations. Different impairment assumptions affect profitability and asset values. Similarly, voluntary changes in accounting policies may reduce comparability between reporting periods even when retrospective adjustment is applied under IAS 8 accounting policies. Changes in accounting estimates and errors. Analysts must therefore understand accounting policies disclosed within financial statements before comparing financial performance across entities or accounting periods. Statement of cash flows versus statement of financial performance. The statement of profit or loss measures financial performance using the accrual basis of accounting, recognizing income and expenses when economic events occur rather than when cash is received or paid. Consequently, reported profits may differ significantly from actual cash generation. The statement of cash flows, by contrast, reports actual cash inflows and outflows arising from operating, investing, and financing activities, providing information regarding liquidity and cash management unavailable from accrual accounting. Strong profits accompanied by weak operating cash flows may indicate aggressive revenue recognition, poor receivable collection, excessive inventory accumulation, or deteriorating working capital management. Conversely, temporary losses accompanied by strong operating cash flows may indicate healthy underlying business performance despite accounting adjustments such as depreciation or impairment. While the statement of financial performance measures profitability, the statement of cash flows provides insight into financial flexibility, debt servicing capacity, dividend sustainability, and investment capability. The two statements therefore complement rather than replace one another, providing a more comprehensive assessment of financial performance when analyzed together. Earnings per share, EPS, as a performance indicator. Trend analysis of EPS. Earnings per share, EPS, measures profit attributable to each ordinary share outstanding and represents one of the most widely used indicators of shareholder performance. The trend of EPS is often considered more informative than absolute profit growth because EPS incorporates changes in share capital resulting from share issues, buybacks, bonus issues, and rights issues. A company may report increasing profits while simultaneously issuing substantial numbers of new shares, causing EPS growth to remain weak or even decline. Consequently, Investors frequently regard EPS trends as superior indicators of management performance because they measure profitability attributable to individual shareholders rather than total corporate earnings. EPS also plays a central role in stock market valuation through price earnings, P/E, ratios, and investor expectations regarding future dividend capacity and capital growth. Limitations of EPS. Despite its importance, EPS possesses significant limitations. EPS measures historical accounting profit rather than cash generation and may therefore be influenced by accounting estimates, depreciation policies, impairment assumptions, and fair value adjustments. Management may also engage in earnings management through timing of revenue recognition or expense allocation, affecting EPS without altering underlying economic performance. Furthermore, EPS ignores differences in capital employed, business risk, financing structure, and growth opportunities between entities. A higher EPS does not necessarily indicate superior investment performance if excessive debt financing or high-risk strategies have been employed. EPS should therefore be interpreted together with cash flows, profitability ratios, return measures, and broader strategic information. Interpretation of not-for-profit and public sector financial statements. The interpretation of financial statements differs significantly between profit-making entities and not-for-profit or public sector organizations because their objectives differ fundamentally. Commercial organizations seek to maximize shareholder wealth and profitability, making measures such as return on capital employed, EPS, profit margins, and dividend capacity highly relevant. By contrast, not-for-profit organizations exist primarily to provide social, charitable, educational, cultural, or community services rather than generate profits for owners. Similarly, public sector entities focus on delivering public services efficiently and effectively while maintaining accountability for public resources. Consequently, analysis emphasizes budget compliance, stewardship of public funds, service delivery efficiency, cost control, liquidity and financial sustainability, achievement of organizational objectives, value for money. Non-financial performance indicators, including service quality, accessibility, environmental impact, public satisfaction, educational outcomes, or healthcare performance, may be equally or more important than accounting profitability. Financial statement interpretation for such organizations therefore requires consideration of operational effectiveness and public accountability rather than shareholder returns alone. Financial reporting significance. Financial interpretation techniques provide valuable insights into organizational performance but possess inherent limitations arising from historical accounting information, differing accounting policies, management judgment, and changing economic conditions. Ratio analysis, EPS trends, and cash flow analysis should therefore be interpreted collectively and supplemented with strategic, operational, and non-financial information. Moreover, analytical techniques appropriate for commercial enterprises may be unsuitable for not-for-profit and public sector organizations, whose primary objectives emphasize service delivery and stewardship rather than profit maximization. A comprehensive understanding of these limitations enables stakeholders to perform more balanced and informed evaluations of financial performance and organizational success.